Friends, we have already seen about change in the useful life of the asset and change in estimated scrap value. So, a change in accounting policy refers to change in principle or a change in the method of principle. Now, let us see one example so we can understand clearly. That is, the original cost of the asset is 11 lakhs and the estimated scrap value is 50,000 and the estimated life is 8 years. Now, after this, the management estimated the remaining life of the asset is only 3 years. So, you have required to provide depreciation amount for the 4th year. So, the solution part is here. The depreciation per annum for first 3 years is 11 lakhs minus 50,000, that is estimated scrap value, divided by number of years that asset will be useful, that is 8 years. So we got an amount that is 1,31,250. So the book value of asset after the 3 years is 11 lakhs minus 1,31,250 into 3, because we have deducting the depreciation for 3 years, so we taken into 3. So 11 lakh minus 1,31,250 into 3 equal to 7,06,250. So we have to required to provide depreciation for 4th year. Now let us see depreciation for 4th year per annum is equal to 7,06,250 minus estimated scrap value, the remaining useful life of the asset, that is 3 years. So 7,06,250 minus 50,000 divided by 3 equal to 2,18,750 is the 4th year depreciation. First, we have last head in the A6, that is disclosures. So those entities which A6 is applicable to entities, those entities should disclose the following. What are they? Let us see. One is method of depreciation and another is total depreciation charged in the current year and the gross amount of each class of depreciable asset and the related accumulated depreciation. And the next is the depreciation rates and useful lives of the assets are to be disclosed only if they are different from the principal rates specified in the statute governing the entity, and if the depreciable asset is revalued, that is to disclose the amount of depreciation based on revalued amount and other necessary disclosures. And the last, that is a change in the method of depreciation is treated as a change in accounting policy, and the disclosures required by AS5 should be made in the financial statements. These are the disclosures of accounting standard 6. This should be maintained in the financial statement as per AS6. Our next standard is accounting standard 10. Now, what are the learning objects in accounting standard 10? That is A, objective; B, scope; C, definition of the term fixed asset; D, initial recognition; E, expenditure incurred after put to use, that is improvement and repairs; and F, revaluation of fixed assets and its accounting treatment; G, retirement of fixed assets; and H, disposal of fixed assets; and last I, that is disclosures. What are the disclosures we should make as per AS10? Now let us see step by step. That is A, objectivity of AS10. AS10 provides when an asset can be treated as fixed asset, its initial measurement, recognition and the further expenditure incurred and its complete accounting treatment up to its disposal. So the objective of the AS10 is when we are fixed asset is put to use, we should make all the measurements, recognition and any expenditure further may be incurred and the complete accounting treatment up to its disposal should be maintained as per AS10. This is the objectivity of AS10. AS10 do not discuss the depreciation or amortization of fixed asset. So this is the objective of AS10. Now, non-applicability of AS10, that is scope or non-applicability of AS10. This standard does not apply in the following situations, that is regeneration resources assets like forestry, livestock, etc. And secondly, recognition in relation to wasting assets, examples coals, mines, oil well, etc. And the third is expenditure on construction contracts, as this construction contracts has a separate standard, that is accounting standard 7. And the fourth, accounting of livestock, no separate standard for this. And the depreciation accounting in relation to fixed asset. So AS10 does not deal with the depreciation or amortization of fixed assets. And the sixth, grants received in relation to fixed asset. So these grants received in relation to fixed asset has a separate standard, that is AS12. And the seventh, accounting treatment for interest in relation to borrowings of fixed assets. So this also has a separate standard, that is AS16. AS16 deals with the accounting treatment for interest in relation to borrowings of fixed assets. And the eighth, for intangible, AS10 does not apply, as we have separate standard, that is AS26. So for intangible assets, AS10 will not apply, only AS26 will apply. And the ninth, accounting treatment in relation to fixed asset acquired in amalgamation. So non-applicability of AS10, what we have read, these total 9 items will not apply AS10. Now next we are dealing with definition of term fixed asset, that is C. A fixed asset is an asset which is held in the business, which an intention to use in the production of goods or providing a service. So what is the intention to use? It is it is to produce production of goods or to provide service through that fixed asset. Note, when the management acquire an asset, the intention of holding an asset is very important. That is, well, let us take one example. A building acquired by a company to earn rentals, that is rental income, or for capital appreciation is an investment. However, if a building is acquired otherwise for use in the business, then it is qualified as a fixed asset. Before treating a resource as a fixed asset, one should always test the definition of fixed asset. This is already we have seen in introduction part of the accounting standards. Now D, initial recognition. This initial recognition has divided into 4 segments, that is, let us see notes. Already we have said that initial recognition of asset is divided into 4 segments. Let us see what are those 4 segments. That is, segment 1, if the asset is acquired by way of purchase and the consideration is in money terms. And the second segment is, if it is acquired by way of purchase and the consideration by way of issue of shares or other securities. And the third, that is, if it is acquired by way of purchase but the consideration is by way of exchange of other assets. And the last segment, that is 4th segment, that is, if the asset is self-generated. Now let us see one by one as segment wise. That is segment 1. If the asset is acquired by way of money consideration, then no doubt the money consideration is taken as the value of asset. Now all the expenditure incurred up to the point of the asset get ready for its intended use can be capitalized with the asset value. And the taxes paid on procurement of fixed asset, if allowed as a credit, should not be capitalized with the asset. So if it is allowed as credit, should not be capitalized with the asset, otherwise you can capitalize. And the last fourth is cost incurred on trial run, so that the asset become ready for commercial run, can be also be capitalized with the asset. Note, however, scrap generated on trial run, if sale value, should be reduced from the trial run cost. And if any discount availed, should be reduced from the asset value. And also gout grants received in relation to fixed asset should be reduced from the fixed asset value as per AS 12. Now so the next segment is, if the asset is acquired by way of purchase and the consideration is paid by the issue of shares or other securities. Now let us study this segment clearly. That is, initial recognition by way of allotment of shares and security. The asset should be recognized at the fair market value of securities issued or fair market value of fixed asset, whichever is more clearly evident. Note, there is no order in applying the above point. Whichever is more clearly evident should be adopted. And now we are going through third segment, that is, if the asset is acquired by way of purchase but the consideration by way of exchange of other asset. Now let us see what about segment 3, that initial recognition when a fixed asset is acquired by way of exchange of another asset, then it is divided into two. That is, generally we should adopt the fair market value of asset given up as value of new asset. And the second part is, however, if the fair market value of asset taken up is more clearly evident, then such value can be adopted as the value of new asset. And the last, that is segment 4, if the asset is self-generated. For this, let us see one example for the fourth segment, that is asset is self-generated. Now we are going through example on segment 4, that is if the asset is self-generated. Now XYZ Limited is a real estate company. This company brings all the bricks, cement, iron rods and raw materials from other companies. So this is the input to XYZ Limited. Now XYZ Limited is whatever it is taking as input, that is bricks, cement, iron rods and raw materials, it is a cost, and it sells or construct a house and sells at a 30% profit. Now XYZ Limited constructing own building for business. Now let us see what is this. So here one should capitalize only cost, that is one should not capitalize cost with profit. So the capitalization should be at cost to cost basis. So that is his own business purpose, so he should capitalize the asset value with the cost to cost basis. So that 30% whatever he is taking as a profit from others should not capitalize for this transaction, because it is self-generated, that is constructing for own building for business purpose. So here the capitalization should be at cost to cost basis, not the cost plus profit basis. And all the expenditure in relation to fixed asset can capitalize with the fixed asset. Likewise, any other indirect expenditure which is allocable or attributable to the development of in-house asset can be capitalized. Now we are going through E point, that is expenditure incurred after the asset is put to use. An expenditure incurred on an asset after it is being put to use. So the expenditure here, it is divided into two, that is revenue expenditure and the other is capital expenditure. First let us see what is the treatment of revenue expenditure. Here revenue expenditure, if it is a revenue expenditure, then treat it as a expenditure and charge it to the P&L account. And if it is a capital expenditure, then what is the treatment? Let us look at the capital expenditure part. Here capital expenditure. If it is the capital expenditure, then treat it as an expenditure and capitalize with the asset value, and the depreciation should be provided accordingly. So the depreciation should be provided accordingly on the asset value. First, let us look at a small note, that is expenditure incurred on existing capital asset for improving economic life or improve the earning capacity beyond the previously assessed one, and the such benefit is more than one accounting year. Such expenditure can be capitalized with the asset. Now we are going through revaluation of fixed asset. Revaluation of fixed asset means upward or downward valuation of fixed asset from the book values. Now AS 10 does not mandate the valuation of fixed asset. It means AS 10 does not say any revaluation of a fixed asset. It means it is up to the management whether the carryout of revaluation of fixed asset. And the revaluation of fixed asset cannot be ad hoc basis. It means only part of the machinery should not do revalued. It means all the machineries or all the assets should be revalued as upward or downward. Now there is a in the revaluation there is also revaluation of fixed asset. Revaluation of fixed asset means upward or downward valuation of fixed asset from the book value. Now AS 10 does not mandate the valuation of fixed asset. It means AS 10 does not say anything for the fixed asset to be revalued. It is up to the management whether the carry out revaluation of fixed asset. And the fixed asset cannot be ad hoc basis. That is, revaluation of fixed asset cannot be ad hoc basis. It means you should not revalue, only the part of assets should be revalued and the other part is should not be revalued. The ad hoc basis means the revaluation of fixed asset should be done all the machineries and not to be selected, and there should be a logic on selection of revaluation of assets. Here it means only machineries can be revalued or only furnitures can be revalued, but you can't do revaluation some of the machineries and some of the furniture. If you want to do so, you should do all the machineries, all the furniture should be revalued. A class of assets can be taken to revaluation. Example, revaluation done only for buildings, and the second example, revaluation done only for machineries. These are the class of the assets, and the revaluation may be upward or downward. Now let us look at accounting treatment of revaluation of asset. Accounting treatment of revaluation of assets. This is divided into two. That is, first, revaluation of fixed asset for first time. Here one is downward and another is upward. For downward, take the downward valuation to P&L account. That is, P&L account data to asset account. And if the asset value is increased, that is upward, take the upward valuation to revaluation reserve account. That is, the asset value is increasing. So fixed asset account data to revaluation reserve account, and the subsequent accounting treatment of revaluation. This is the second one. Here you look at, earlier there is upward and now at present also there is upward. So the accounting treatment is taking upward valuation to P&L account. And then when we come to second, that is earlier also down and now also it is downwards. So taking the downward valuation to P&L account debit side. The third, earlier it is upward and now it is decreased. So old 5 rupees, new 7 rupees. So it is increased. So what is the accounting treatment? Here 5 rupees is goes to revaluation reserve account and the 2 rupees goes to P&L account. And when it is 3 rupees and the next it is upward, that is 4 rupees, it is increased. So you should take this the balance amount to revaluation reserve account debit side. And the last, earlier downwards and now it is upwards. So old 5 rupees, new 4 rupees, so it is a downward. So such amount should be taken to P&L account. And when it is 5 rupees and the asset value is 7 rupees now, so what is the accounting treatment? P&L account credit side should be taken with the amount 5 rupees and the revaluation reserve account should be taken credit side as rupees 2. This is the accounting treatment of revaluation of assets. Now, retirement of fixed asset, that is, an asset is said to be retired when it is not in active use, that is regular use. As per AS 10, when an asset is retired from active, the book value should comply with NRV. The asset should be carried with book value or NRV, whichever is low. If the book value is 100 and the NRV is 80, then 20 should be taken to the P&L account debit side because it is a loss to the entity. Now let us see example so we can understand the different treatment of retirement of fixed assets. Here, retirement of fixed asset example: book value, revaluation reserve balance, and net sale value we have taken. And in case 1, that is, book value is 100 rupees, there is no balance in revaluation reserve account, and the net sale value of asset is 110. So here 10 rupees that it should be taken to the P&L account credit side because it is a profit to the entity. And when we come to the case 2, that is, book value is 100, revaluation reserve balance is nil, and the net sale value is 80, then 20 should be taken to the P&L account debit side because it is lost to the entity. In case 3, that is, book value is 100, revaluation reserve is 20, and the net sale value is 150. Here the balance amount in revaluation reserve account should be transferred to the P&L account, and when the asset is sold, the balance amount, that is book value and the sale value, whatever profit you are arrived, should be transferred to the P&L account. Here the revaluation reserve balance 20 rupees is transferred to the P&L account, and the balance, that is 150 minus 100, sale value minus cost book value, remaining 50 rupees also we have transferred to the P&L account. In case 4, here book value is 100, revaluation reserve is 20, and the net sale value is 70. Now let us see the accounting treatment for fixed asset, that is, here the book value of asset is 100 and the sale value, we sold the asset at 70, so the revaluation reserve we have, so we can compensate the sale loss on the sale of asset. So the balance portion, that is 10 rupees, that is transferred to the P&L account debit side because it is a loss to the entity. So this is the different situations how we treat the assets to revaluation reserve account or P&L account. Now what are the disclosures of AS 10? So these are some of the disclosures of AS 10, that is, accounting policy of fixed assets, and second, gross or net book values of fixed asset at the beginning and the end of the accounting period, showing additions, disposals, acquisitions or other movements. So whatever in the beginning of the year and the end of the year, whatever in this middle, what are the transactions are happened, that is any addition of fixed assets, any disposal of fixed asset, any acquisition or other movements should be disclosed as per AS 10. And the expenditure incurred on account of fixed asset in the course of construction or acquisition should also be disclosed. And the revaluation related to disclosures, that is method adopted to compute the revalued amount and the nature of any indices used and the year any appraisal is made and whether the external valuer are involved. So these are the disclosures of AS 10. Now let us see some of the examples of AS 10. Now we are taking one example on AS 10. The question is, as an auditor, what would you do in the following situation? What is the situation? That is, one customer from whom 5 lakh is receivable for credit sale, given a asset in full settlement of the dues. So the directors estimated that the market value of asset is 5,25,000. As on the date of balance sheet, the asset has not been registered in the name of auditee. So what you will do in this situation? Just think 2 minutes. So here this question is based upon the initial recognition and what we have learned in segment 3. That is, when a fixed asset is acquired in exchange of other asset, the asset received is usually recorded at the fair market value of the asset given up or the fair market of the asset which are you are acquired. So the fair market value of asset which you given up or the fair market value of asset which you are acquired, whichever is more clearly evident. Therefore, in our example, it shall be more appropriate to record the cost of the motor car at 5 lakhs, since the value of asset given up is more clearly evident than the fair market value of asset acquired. That is, as the fair market value of car is estimated by the directors. So this is the question based on the initial recognition of asset. Now this question is based on the disclosure part of AS 10. Let us see what is the question. A partnership firm revalued its asset like land and building. The firm is adequately disclosed the revalued amounts in the balance sheet. As an auditor, do you approve the disclosures given by the partnership? What is your answer? So as per AS 10, the disclosures made by the firm is not adequate. So what we should do is, as per AS 10, the entity should disclose the method of revaluation, nature of indices used, appraisals made, etc. in the notes on accounts. So as per AS 10, the firm is not adequately did the revaluation. So as per AS 10, we should disclose the method of revaluation, nature of indices and the any assets is appraisal or not, we should show the disclosure as per AS 10. So this is the example on the disclosure point. Now let us see last example on AS 10. Last example on AS 10. As an auditor, comment the following situation. B Limited acquired a car for its MD on hire purchase basis. The interest payable as well as penalty for the payment of installment was added to the cost of car. So as an auditor, comment on the situation. Here the penalty and interest on the installment payable does not form part of the cost of the asset and therefore should not be added to the cost of the asset. Treatment of cost and outstanding installment is correct as per AS 10. So friends, only the treatment of cost and the outstanding installment is correct as per AS 10, but when we go to the penalty and the interest on interest on installment, it is not to be added to the cost of car as it is not included in the AS 10. as an auditor, comment on the following situation. B Limited acquired a car for its MD on hire purchase basis. The interest payable as well as penalty for the payment of installment was added to the cost of car. So the penalty and interest on installment payable does not form part of the cost of the car, therefore should not be added to the cost of car, and the treatment of cost and the outstanding installment is correct as per AS 10. Only the penalty and interest treatment is wrong as per AS 10. It should not be added to the cost of car. With this we have completed AS 10. Now let's see another standard. Now next standard is AS 2, that is valuation of inventory. What are the learning aspects of AS 2? That is meaning of the term inventory, non-applicability of the standard, initial recognition, subsequent measurement, and the last is disclosures. These are the learning objects of AS 2. Now let us see what is inventory. Inventory, generally inventory refers to stock. A inventory can be either raw material form, work in progress form, finished good form, and in the consumable form. As per AS 2, a inventory is an asset held for sale in the ordinary course of business or for use of ordinary course of business to manufacture goods. Even a consumable which is consumed in the process of production or rendering a services is taken as inventory. Examples: loose tools, motor spirit is generation of power, etc. So these are the loose tools, motor spirit also treated as a inventory, and it is also treated as a assets. Now our next is non-applicability of the standard. So this standard does not apply in the following situation. If shares and debentures are held in the form of inventory, as the principle of AS 13 will apply. Inventory of livestock, forest products, mineral oils, etc. So AS 2 does not apply to the inventory of livestock, forest product, and mineral oils. And AS 2 does not apply to work in progress as a result of construction contracts, because there is a separate standard for the construction contract, that is AS 7. And the work in progress of services provides, that is AS generally inventory is a intangible form. It is not the mandatory that only a tangible substance is taken as inventory. For a software entity, even a computer software is treated as a inventory. So for example, for software entities, even a computer software is treated as a inventory, as it is the asset to their entity. And inventory can also be immovable, such as land and building. Now what is the initial recognition of inventory? Let us look a small note on initial recognition. Now initial recognition of AS 2. In case of purchase, generally the consideration paid for acquiring inventory is taken as a cost of inventory. Even all the costs incurred which are incidental to bring the inventory to present business location can be added to the cost of inventory. These examples for such point is inward transportation, inward insurance, loading and unloading, etc. And the third point, that is cost incurred toward storage, upkeep, security charges, insurance, and selling and distribution overheads cannot be treated as a cost of inventory. And when you take a loan for the purchase of inventory, then interest on loan, such loan cannot be capitalized with the cost of inventory, as generally the inventory or purchase of inventory do not take substantial period of time. So this is the case when the inventory in case of purchase, that is initial recognition of inventory in case of purchase. Now let us see in case of house developed, that is initial recognition in case of house development. Now initial recognition of AS 2 as per case of house development. In this case, all the direct expenditure should be added to arrive at the cost of inventory, and all the indirect expenditure incurred for generation of inventory which are allocable or attributable for the creation of inventory can also be treated as a cost of inventory, and variable overheads should be observed on the basis of actual output. So these are the treatment when we come in the case of house developed of inventory for initial recognition. And what is the fixed overheads portion? It is, in case of fixed overheads, fixed overhead is absorbed on the basis of normal production. That is, it is divided into two parts. If actual production is less than normal production, or actual production is greater than normal production. In case of actual production is less than normal production, absorbed on the basis of normal production. That is, let us take one example so we can understand some more clearly. That is, normal production is 20,000 units and the actual production is 19,800 units, and the fixed overheads is 1 lakh. Now what is the accounting treatment for this absorption overhead rate in case of actual production is less than normal production? Here it is, the absorption rate per unit is fixed overheads divided by normal production. That is 1 lakh divided by 20,000 is equal to 50. This is the absorption overhead rate as per if actual production is less than normal production. Now in the case of actual production is greater than normal production, observe as per actual production. Now let us take one more example for this. It is normal production is 20,000 units and the actual production is 21,000 units. Now what will be the absorption rate per unit? That is, absorption rate per unit is fixed overheads divided by actual production. Now what the amount it is? 1 lakh divided by 21,000. So one of the amount you will derive an overhead rate. Initial recognition of inventory. Already we have seen initial recognition of inventory in case of purchase. Now let us see initial recognition of inventory in case of house developed. That is, all direct expenditure should add it to arrive at the cost of inventory, and all the indirect expenditure incurred for generation of inventory which are allocable or attributable for the creation of inventory can also be treated as cost of inventory. So that is, all the indirect cost which are incurred for the generation of inventory is also treated as a cost of inventory, that is involved in the cost of inventory. Now when we comes to the variable overheads should be absorbed on the basis of actual output. So variable overheads is absorbed by the actual output, and when we come to fixed overheads, these fixed overheads are absorbed on the basis of normal production. That is, it is divided into two. That is, actual production is less than normal production, and another one is actual production is greater than normal production. If actual production is less than normal production, so the absorption of overheads is based on the normal production, and if actual production is greater than normal production, then it is absorbed on the basis of actual production. And now let us see the treatment of normal loss and abnormal loss in case of inventory as per AS2. That is, let us see one example here. Left hand side we have taken quantity and the right hand side we have taken cost. Here purchases, that is 1,05,000 liters of petrol, its cost is 40 lakhs, and for the transportation it is incurred 2 lakhs, and when we come to the loading and unloading charges were 3 lakhs. Now total liters of petrol is 1,05,000 and the total cost incurred for that it is 45 lakhs. Now what is the cost per liter? It is 45 lakhs divided by 1,05,000. Per liter is equal to 42.85. It is the cost per liter. Now we have incurred normal loss, that is 5,000. So we have deduct that normal loss from the quantity. So it arrives at 1 lakh. But cost doesn't change because normal loss will absorb by on the production. So 45 lakhs is the cost for 1 lakh. Now what is the per liter cost? That is 45 per liter. And when we comes to the abnormal loss, it is also 5,000. So now quantity is 95,000. Here the quantity after we should deduct the cost also. So we arrive the cost at 42,75,000. Now average cost is per liter is 45 rupees. From this, it is very clear that from this example, it is very clear that normal loss should be reduced from the quantity, but not the cost. Therefore, normal loss will increase the average cost per unit. When it comes to the abnormal loss, should be reduced not only the quantity but also the average cost. Therefore, after booking abnormal, the average cost per unit remains same. And what will be the treatment of storage cost? Storage cost will be generally not be considered as a part of the cost of inventory unless storage is an integral process to general or inventory. And what is the treatment of administration overheads? These are the additional points. Let us say administration overheads generally will not be considered as a part of the cost of inventory, and selling and distribution cost will also not form part of the inventory. So overheads like administration overheads, selling and distribution overheads, these are not these are not form for part of the cost of the inventory. Now let us see some of the general points, that if inventory is purchase inventory, then trade discount will not form of the inventory cost. And if in case of purchase inventory, any taxes are paid at the time of its procurement which are allowed as credit. Example, input VAT credit, excise duty, sen VAT credit, then even such input tax should not capitalize with inventory. Now let us see one example. If raw material are purchased at the rate of 112.5 with 12.5 as excise duty credit, then entry would be raw material account data 100 rupees, excise duty account data 12.5 to bank account, that is we are paying for the 112.5. Here the inventory is valued at the rupees of 100 and the excise duty is 12.5. Now we are going through methods to arrive at cost of inventory. Here we can do these two types, that is if inventory is of the nature which are not interchangeable, then follow specific cost method. And if the inventory is interchangeable, then either FIFO method can be followed or weighted average method can be followed. Now why we are not following the LIFO method? Here the note is, India being an inflationary based economy, AS2 does not permit to follow LIFO method. Here for as we said that if inventory is of nature which are not interchangeable, follow specific cost method. One of the example for it is antiques. For antiques we follow the specific cost method. Now valuation of inventory on the date of balance sheet. Valuation of inventory on the date of balance sheet. Here we should follow as per accounting standard 2, the inventory should be valued at cost or NRV, whichever is low. Here NRV refers to net realizable value, that is estimated selling price minus estimated cost to make a sale. That is the meaning of NRV. Now last topic, discuss whether in the following situation the raw material is to be valued below its cost. Now raw material original cost is 100 and NRV is 95. Now for the conversion of raw material into finished good, there is a conversion cost is expenditure, it is booked that 50 rupees. And now after the finished good is completed, the sale value of finished good is 180 and the expenditure incurred to make a sale, it is 10 rupees. Now net selling price is 170. Here net selling price is equal to 170 minus conversion cost 50 rupees minus opportunity cost 95. So the benefit is 25 rupees. So there is a benefit for conversion of raw material into finished goods, so the conversion can be done. From this example, as it is beneficial to convert raw material into finished good, it is advisable not to downward valuation of raw material. So show its cost at the original cost, that is 100 rupees. And last we should show disclosures of AS2. These are the following disclosures we should show at the financial statement, that is the accounting policy in measuring inventory and including the cost formula used, and the total carrying amount of inventory and its classification appropriate to the enterprise. So this disclosure should be shown in financial statement as per AS2. With this we have completed AS2. Let us meet with another standard in next video. Thank you.